Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. This is Bobby Rains here for our once every 3 weeks members only workshop. Yeah, let's get started. We're going to do our normal thing this week. We got market update, what's going on in Investors Observer, and then we actually did receive a couple of questions ahead of time this time, so we'll be going through those and any other questions that anybody has. You can put questions in the box as I'm talking, and I'll either get to them in the moment or save them for the end. But either way, don't feel like you need to sit on a question. You can go ahead and put it in there whenever you are ready. Yeah, if you want to submit questions ahead of time, just do that. Mention the workshop, and we'll usually try to get those together, and I can put together a few thoughts or bullet points, or at least have a more well thought out question. All right, with that, let's get to the market update. 2 years, the S&P 500, we're back within a couple points of an all-time high. So that's where we are there. We'll see if we can break out. As far as that goes, typically the more times you hit an area and then don't get through, the harder it gets to get through the next time. So we'll see if that happens again now that we've kind of come into this area twice. We'll see how that goes. And then this next chart is a little bit different. So this is the S&P 500 in red. The axis is on the left. And the 10-year Treasury maturity rate on the right. You can see here the spread between the two is pretty wide. Obviously these are on different axes, but you can also see where the spread doesn't typically usually get too wide. Rates and stocks tend to go sort of in similar directions. And then they often correct. You can see it got kind of wide here last year and then came back together, and it got kind of wide here last year and then came back together. So that's something to kind of keep an eye on. It seems to me it would be kind of weird for the bond rally to suddenly reverse. It's not impossible, but the bond market tends to be less volatile than stocks, and having a lot of volatility like that in terms of people just suddenly selling bonds, which would send the yield higher, isn't really how that works most of the time. So it'll be interesting to see what exactly transpires there. And then we got everything else. The Fed was out today. They didn't cut. They did take patient out of the statement and replaced it with things like uncertainties about the outlook have increased. They're going to be closely monitoring and acting as appropriate, which is sort of a transition in tone from, patient was the buzzword before. They took out, some sort of passive language and put in some more active language, even if they didn't actually do anything. And the dots, which are part of the associated materials that come out a couple times a year, essentially some projections about things, suggest about a 50 basis points, 0.5% to be cut off of the interest rates by the end of the year, and then no cuts after that, which is sort of interesting. But it's also worth noting that the dots have rarely predicted actual events. For pretty much the entire recovery, the Fed is expected to raise rates faster than they have, especially in the last few years. Once they, sort of tapered down QE and stopped, moved the rate off of zero. They expected the path of increases to be higher, and then the data from the economy just has never really been there to support that, and so they have raised much slower than they had projected them that they would. So the dots are interesting. You could say that they rarely predict actual events. I suppose another way of looking at history is they've typically understated what interest rates end up being. Don't know that that means they're going to cut more than 50 basis points before the end of the year. You know, futures pretty much now have it, since 2 o'clock, have about 100% chance of a cut in July. And then, there's probably a pretty good chance for one in September also. We'll see where they go there. I've seen people on Twitter today saying the Fed would do 50 points in July and then that would be it. That seems a little weird to me, but yeah, we'll see. Yeah, and then other things that are going on, trade. The Fed mentioned trade quite a bit in terms of being a drag on the economy. But outside of what the current status is, I don't really think anyone knows anything. I know Trump and Xi are now scheduled to meet at the G20, but those guys have been talking since, December of last year was it December 2017? Yeah. The trade talks have been going on for an awful long time, and we haven't really gotten anywhere except for higher tariffs. So I don't necessarily expect two people who don't necessarily have the most in the weeds grasp of things to be able to hammer out a deal. I think the best case scenario is they come out with a framework for more talks, but we will see. And yet economic data is still sort of softening. The Fed said pretty much that today also. It still shows a strong economy overall. Powell did say in the press conference that the even while the unemployment rate is incredibly low, we're not seeing things in wages and some other things, outside of the headline unemployment rate number that suggest we're actually that close to full employment, which honestly, that was maybe the most dovish thing that came out of the whole thing today. It'll probably get sort of overlooked, but the unemployment rate seems to have been, the unemployment rate as a predictor of where we are in regard to full employment and thus when some inflation would start to take hold has been pretty broken for the entire recovery. So that was an interesting thing to hear. But yeah, we'll see where things go from there. And then, across the pond, that's obviously a big source of uncertainty. They're getting a new prime minister, but they have all of the same problems. Putting a new face on it, I'm not sure if that will really do much in terms of actually solving the problem, but we'll see. Maybe it will. Getting people all on the same page to agree to a thing seems complicated based on what the issues are, but maybe a new person can do it better than Theresa May could. We will see. All right, so let's get into, like I said, we did get a couple of questions this week. We got one this afternoon from Theodore, who said, what does a negative bid quote for an option mean? Know if he is on the call. I would be interested to get more information about this because I've never actually seen a negative bid. I've seen 0 bids and I've seen no bids. I've never actually seen a negative bid. A negative bid seems like it would mean that somebody is going to pay you to take it off their hands, which I don't think that's likely. Depending on what platform you're using, it could suggest that, if you're looking at, selling it, that option, then, maybe it's doing the math for you that's a credit. I'm not exactly sure what you would be looking at that would give you a negative bid, though, because that's not, certainly nobody's going to give you money to take an asset, in my experience anyway. And then we had another question about what to do when a covered call goes bad. I couldn't put my hands, I have a nice flow chart that I put together at some point, and I couldn't find it today. But the sort of mental math essentially that we try to follow is would you still buy the stock today? All right, so if all of a sudden, you wake up in the morning and you're down in the position and you don't like the stock anymore, probably not holding the stock anymore is a good answer there. Obviously, if you're underwater, you're going to take a loss on that, but take a loss now before it gets worse, can certainly be a good decision in some cases. Another thing to keep in mind is, as the stock falls, the price of the option that you sold will fall. So even if the stock is down on something that might be just a bad day in the stock market or whatever, and the value of that option gets real low, sometimes it makes sense to just buy that option back and then wait. Some brokerages have no commissions on, like, I think they call it nickel buybacks. So if the price of the option falls to a nickel or less, you can buy it back and not pay a commission. And then if the stock bounces back the next day, you can sell that same call again and just sort of double up on sold call credits. But at the very least, it sort of keeps your options open, because you don't want the value of the option to go to zero and you do nothing, and then the stock rises and the value of the option goes back up, and you could have taken that off for basically no price, and now all of a sudden you have to pay to buy that option back. And then you look at what your options are for selling a call against the stock. Selling a new call against it. Things to be considerate of are earnings, other corporate news potentially. Earnings is a big one because it's on the schedule. Biotechs, sometimes there's FDA decisions and things like that to be mindful of. And then, hang on a second here, let me find mine. Here we go. All right. And then like as far as selling another call goes, sometimes it works to, let's pick something easy here. All right. So our out of the money covered call wizard has a position repair tool. So if your cost basis on, let's say, Coca-Cola, because we're looking at it, is 55, you can hit the position repair calculator and it'll try to find something that will get you. Essentially what this is trying to do is find math where the strike price is more than your new cost basis. That's not necessarily possible. In this case, you're looking at September of next year, which for Coca-Cola, maybe that's not so bad. For some other stocks, that's an awful long time to hold it. There's a lot of uncertainty there. And then in other cases, you may have to sell a call that would leave you a little bit underwater if you were to be assigned, and then just keep an eye on it, and you can try to roll it as it goes back up. In terms of things like earnings, we have had, I would say, mixed success in terms of trying to sell a new call and then use some of that money to buy a put to sort of have some insurance in case the stock really tanks after earnings. We've had some cases where that has worked out, and we've had some cases where the earnings were great and the stock took off, and now we kind of wish we hadn't spent money on that put because it ended up cutting into our total return on the position. Those are the kinds of things that you want to consider. But as a general rule, if your trade goes bad and you decide you don't like the stock anymore, not having the stock in your portfolio anymore is a pretty good way to handle that. You can certainly, it depends on the situation, right? If it's down big on no news, you can maybe wait for a bounce the next day. That's often a thing that you'll see. If suddenly the company's product starts killing people, that's not usually a story where you get a next day bounce. So it really kind of depends on the position that has, the reason the trade has started to go bad in terms of why you would want to do that. That's sort of the basic mental sort of flow chart of how to walk through those things. All right, so Joel, this tool is on the trade idea generator. So you can go to Trade Idea Generator, and then whatever the underlying stock is, just search for it. And so, and then it's right here above the trades, out of the money covered call tool. You can pop that open and put in a cost basis, and it also works, even if you're not underwater, if you want to try to find an out of the money covered call to sell to generate a little extra income, you can do that, and it'll usually try to find something that has less than about a 30 delta, which means it has a 70% chance of not being assigned. Obviously, 3 out of 10 times, you'll be assigned there. So you're going to want to keep an eye on that if it's a stock you really don't want to lose. But it does work, and it's a nice tool to have there. All right, looks like we got some more questions here. All right, so vertical put spread suggestions have been few and far between. So yeah, the vertical spreads portfolio has been lighter on positions than typically we would like. But between the sell-off in the month of May and the rally in June, we try not to put out positions like that when there's a lot of volatility, just because it is very difficult strategy to sort of repair and recover from. Unlike covered calls or the diagonal spreads, there aren't really a lot of separate options. I think I saw another question come in about repair of those. But yeah, we're watching and looking. I'd like to have some more things in there, but we're really kind of waiting for opportunities. As far as that goes, we would prefer to put out good trades than put out bad trades just to put out trades. Let's see here. Joel says, are there strategies that we can take advantage of with regard to China trade and Mexico trade? That's a very good question. I wish I knew the answer to that, because I feel like if I knew the answer to that, we could make a lot of money. Unfortunately, I think because no one really knows what the future holds there, it's really hard to trade on that. When you have things could go a whole lot of different ways, it's really hard to make any sort of trade. And I'm not, I don't have the, I'm not a volatility trader. I think that's probably actually the thing that you would want to trade there, is just overall sort of stock market volatility. But that's not really what we do here. Just in terms of it not being a trade where I feel like we have any sort of edge. All right, so Robert says, if I have a vertical put spread that goes in the money, what other options do I have besides closing out the trade to minimize a full spread loss? Yes, so you can try to put on some position on the other side, an iron condor as you suggested. You can try selling the bought leg, as that will, that leg is going to go up in price. You could try selling that bought leg, and then you have, an in the money short put, and you would, basically take ownership of the stock. Which, again, if it's a stock you like, you can buy it at this point. In most cases, it's going to be at that point some premium to your cost basis, and depending on the stock and what you the kind of credit you got for your spread, and maybe a big premium or a small premium to the current price. But if it's a stock you want to own, that is a thing that you can do. I've seen some other option services use that as a strategy, and that doesn't seem like a terrible idea. Rolling is another thing that people do, but the thing about rolling the position is, right, all the legs of the position have the same expiration date, and so you have to close both of them and then open a new position. Typically, you're closing both of them for a debit that's a lot larger than your previous, a debit that typically wipes out your credit and moves the position to a loss at that point. And now you're going to go and put on a new position. I mean, almost every case I've ever really seen, either you're going to be putting more money into the position in terms of, buying that debit, and then, you're putting either the same amount at risk further out, or, some people to try to make up some of the debit they had to pay to close the initial position will have a wider spread or something like that. So, and now you have a stock that just did something you didn't expect it to do. And you're putting on a new trade with the same bias with probably more money at risk. I'm sure there are situations where it seems like a good setup, but as a general rule, if something just did something I wasn't expecting it to do, and it went against me, putting more into that position is just not a situation I've ever really felt comfortable with. So of all the options, sort of the rollout is the least comfortable to me. What we tend to do here is just close it out. I've thought about doing the covered call thing a few times, and the thing that keeps me from doing that is, somebody who runs this portfolio for people, is that, right, like the capital requirements of a $5 credit spread versus a covered call on sometimes a stock that, we have Disney in for $130 now. Telling people like, oh, hey, this trade that was going to cost you $500 is now going to cost you $130 times 100 shares. I don't feel like that's a thing I can do to subscribers. So that's why we don't do that here. And saying there's a giant capital requirement on the portfolio, but we're hardly ever going to dip into that doesn't seem from a publishing standpoint, it doesn't make a ton of sense to do that. But that is a strategy that I know that some people use. And if you're willing to, own the stock and have the capital and the time, I think that's probably a pretty good strategy. And the condor can also work to sort of minimize the loss. It depends, though. Depending on how far the stock has moved, you probably don't want to, cross the sides of your trade. So so there's possible that both sides could go a little bit bad. So yeah, it really sort of depends on the position with the best move there, and that's why our general rule is just to sort of close them out. And that's also, to get back to the earlier question, why we're pretty cautious on putting those out, because there's not the ways to play defense on those positions are pretty limited. And then let's see, Thomas asked, about the NSC position. It is down a little bit. It seems to have sort of bottomed out here. We said in our note when we opened the position, I think, the sentiment didn't make it into the note, but there is some support here, and it's kind of held a little bit below that support, but there is some support here, and we'd like to kind of see it stay in this range and then go back up. The sold leg is a July, and then the bought leg is a September, so we have some time on it. It is the position that I spend the most time looking at, but it's not one that I'm overly concerned about at the moment. I'd like it to be a green one with all the rest of these guys, but I'm not losing too much sleep over it yet. And let's see, Kit has a question about the portfolio performance. I don't have year-to-date performance stats, Kit. You can go look at the closed trades here. And this we have discovered actually copies out pretty well. You can copy it and paste it straight into like Excel or whatever and do do whatever sort of calculations you want, but I don't have, I don't have those stats immediately available. I can say the performance is not where I would like it to be. It's been a sort of challenging environment the last year and a half or so. But yeah, that's all I can really offer about the portfolio performance at the moment. All right, yeah, that's all the questions that have come in so far. If there are more questions, I'm here and happy to answer them. All right, so our next workshop will be 26/3, about July the 10th. We'll send out invitations ahead of time. We'll also send a link to the recording and the slides from this presentation tomorrow. They'll be on the website also. Yeah, in the meantime, don't hesitate to reach out with questions. If you're looking for more, sort of market commentary outside of our other stuff, we have 2 pieces a week that get posted in the Market Intelligence Center. The Week in Review gets posted Friday after the close, and it is exactly what it sounds like in terms of being a review of the week. And then the Market Week Ahead gets posted Monday afternoons, and we try to give a preview of what we expect to be the drivers. What we expect to be the drivers of the market in the week ahead. Okay, so a new question from Robert says, there are a lot of stocks in the basket. How do we decide which ones are in the investor's keyhole? I mean, so each piece of the investor's keyhole has a sort of a theme, right? So we have the morning news. That one's pretty simple. It's, we're usually looking for something that's rising in the morning on positive news. Upgrades and downgrades is the same thing. Try to look for something that's been upgraded where we like the stock and the trade. Unusual options activity. Most of the time we're looking for call buying. Try to spot that, and then find a stock that has call buying on it that we're like the trade on. And then insider activity is a similar thing where we're looking for we're looking for insider buying activity in most cases, outside of like option grants and things like that. and then trying to find a trade we like on that as well. So yeah, I mean that's how we do it typically, is start with the theme of the theme of that particular investor's keyhole trade, and then work from there in terms of what's in the news today, or what has insider buying today, or what's seeing a lot of call volume today, and that's typically how we pick those out. Let's see. Joel says, "Do we have any thoughts on pot stocks as a sector?" The weird thing about pot stocks is they're all over the place in terms of not really being in a sector. Right, like some of them are very much like agricultural plays, right? Like it's a company that turns seeds into plants and then sells some plant matter. And then there's people who are buying plant matter and turning it into various consumer products. There's some things that are in the, let's call it in the supplement industry. There are some that are very much in the like biotech industry in terms of like trying to actually develop pharmaceuticals, as opposed to the supplement industry. It's sort of a way to, right? You can't actually say that your product is medicine, but you also don't have to prove to the FDA that your product will help sick people. So that's another thing that people do. And then there's like, yeah, there's people who are providing financial services to dispensaries. So the idea of pot stocks as a sector isn't really a thing, to my mind. Like I mean, it's certainly a thing to keep an eye on, and it's a thing that's growing. But in terms of like where to put money there, I don't have a good handle on it. I mean, it's still illegal at the federal level in the United States. If there's a pure play Canada producer, I don't know of one off the top of my head. CGC might be one, but I would have to look into it before I really endorse that as an idea. That's probably the kind of thing you would look at. And then like Motley Fool has done some things with lists of pot stocks. And I think their favorite has been Scott's Miracle-Gro, which certainly makes sense in terms of, if you're, trying to grow, trying to do high yield things like that, you're going to want to, fertilizer and things like that. I imagine legalization in this country will see, in addition to industrial production, a whole lot of home growers. And so that kind of makes sense. I don't think that's on any sort of casual investors list of pot stocks, just because it doesn't really come to mind. But yeah, my suspicion is that much like you see with most bubbles, some of these companies will go bust. Some of them may get huge. Some of them will be bought by somebody else, and investors in those will make a lot of money. But I don't feel like I have any way to tell you which ones will go bust and which ones will make investors really rich. The ETF may be a way to play it, in the sense that you get exposure to a whole bunch of things. And hopefully the ones that get huge will outweigh the ones that go bust. But I don't have a good sense for how to invest in that as a thing right now, just because, there's too many unknowns and regulatory issues. All right, well, if there's no more questions, I'm going to go ahead and sign off here. Thank you all for coming. I enjoy doing these. Like I said, get questions in ahead of time, and I can give you at least better thought out answers to most things. But I'm certainly happy to take them as they come during the webinar as well. Thanks for coming. Look for that email tomorrow with the link to the recording, and I will talk to you in 3 weeks, if not before.